Everybody, Jeff McGinnis, CrossCountry Mortgage, and today is part 2 of 4 of when will rates go down. So I wanted to, last week we talked about inflation being the main driver of why rates are up. And I wanted today to talk about inflation and bonds. And why that's important is because our 30-year fixed rate mortgages are based off of what's called a mortgage-backed security or a mortgage bond. So inflation adversely affects the price of a bond. And when the price of a bond goes down, then the rate of return on that bond goes up. And so you can see on our chart here, over the last year, this is the price of the bond. So red on this chart is bad, green is good. We've had a lot of red up until, fairly recently. Now, let's look at the US inflation rate. So this chart shows us over the last 3 years, but let's look at the last year, right? So in January, January of 21, inflation was super low, right? And it's been steadily climbing, right? So we had really low interest rates back here. We kept the rates artificially low here, which caused a little bit more problem, but I won't get into that too much right at the moment. But let's just look at the inflation rates that have basically eroded the price of these bonds. So if we look back in July, right? So inflation numbers came out. Look at this day. It drops the price of the bond, which then increases the rate. And as a consumer, that's what you experience. You get higher interest rates. Now, next week, when we get into part number 3, I'm going to talk about the Fed and what they do and what they've done and what they're trying to do for inflation. So this is where we start to answer the question, when will rates go down? So stick with me on that. Additionally, if you want the full education on rates, real estate, and recession, feel free to click the link to that video, that webinar that I've recorded for you, and feel free to watch that. While you're there, subscribe to my YouTube channel. Would love to have you as a subscriber. All right, have a great day. Talk to you later.